Wonderful. Hi, my name is Alana Hirtle, and I'm the Business Analyst and Self-Employment Benefits Coordinator with CBDC NOBL in Colchester County. So what is CBDC NOBL? Well, a CBDC is a Community Business Development Corporation, which is a federally funded not-for-profit corporation whose sole mandate is to support business in the community. There are 13 CBDCs in Nova Scotia and 41 across Atlantic Canada. If you're watching in a different area from Colchester County, you can go to cbdc.ca and find yours to reach out to the correct office. Our organization, Northern Opportunities for Business Limited, or NOBL, is governed by 24 volunteers across the 3 counties which we serve, which are Colchester, Pictou, and Antigonish. We have 6 staff across the 3 counties, and I am alone here in Colchester County looking after your needs. Our primary role, as I mentioned before, is to support business in the community. And we do that through 3 major streams: financing, training, and advice or counseling. So we do offer small business loans up to $300,000. We partner for training with both with the province in 2 ways, with the Labor Skills and Immigration Department to produce the workplace education training programs, which happen in 3 semesters a year. We also work with Employment Nova Scotia to help produce the Self-Employment Benefits Program, which is a 40-week program for individuals who are unemployed and have an attachment to EI and are looking to start a business. And that you can find out more about through your local Nova Scotia Works office. And then a good chunk of what I do is advice or counseling. So people who would like to start a business and don't know where to start, or people who have already started and need some help and may need to look at different ways to market, or look at a social media program, or need help with what their financial reports tell them. It really is very individual, and it depends on what every business owner needs. Okay, so today we're going to talk about business planning. So I think the first thing to address is, what is a business plan? Well, it's a formal written document that contains the goals, the methods for attaining those goals, and the time frame for the achievement of the goals. It's essentially a roadmap that outlines for you where you're going, how do you know if you've gotten there, and how are you going to get there, basically. So where are you going, how are you going to get there, and how do you know when you've gotten there as well. All right, so why would you need a business plan? Well, it'll help you form and shape your vision and goals. Again, how do you know what success is if you don't outline it and make it real and measurable? It'll help you clarify your offering. What exactly is your product? Is that something that people need? Is it something that people are looking for? Does it solve someone's pain point or their problem? A business plan will help you understand the market, because you need to do research as to what is already happening in the market. So what is happening in the market? Where do you fit into the market? It'll guide you through each stage of starting and managing your business. If you are starting your business, your initial business plan should cover your business activities for the first 2 years. And then a business plan is not something that should go on a shelf and gather dust. It is something that you should pull down, well, at least quarterly, and see if you've been able to achieve what you thought you were going to, what worked, what didn't work, what would you tweak for future. So at very least, you should write your first couple of years business plan. And then every year, at least, you should pull it out and see, where are you as compared to where you thought you were going to be in the plan. And then you're going to want to tweak it for the next year. It's a tool, basically, to help you detail all the components of your business, including human resources, which sometimes gets left out. And it's going to keep you focused on your financial goals, because you do need to create metrics or measurable goals, so that, again, if you know where you're going and what does success look like for you, then you'll know when you've gotten there. If you don't set any financial goals, you may be plugging along just great, but what does success look like does need to be something that you actually measure, and financial would be one of those success metrics. Okay, so key elements of a business plan, and this does not necessarily list all of the components of a business plan, but these are kind of the high points we're going to talk about today. So a situational analysis or an executive summary, you can include that as well. Your vision and mission statements, your corporate structure, roles of key personnel and directors, market summary and competitors, a SWOT analysis, and we're going to talk more about all of these things as we get further into the slides. Your marketing initiatives, timing and budget, your key product or service, and your pricing structure, the personnel requirements, and last but certainly not least, your financials. And there are 3 main documents that you need to be incorporating into your business plan: a cash flow forecast and pro forma income statement and balance sheet. Okay, so what is a situational analysis? Well, really, it's the road thus far. Both external and internal factors, what's going on in the market now. Is there a pain point? Is there a demand for the product that you want to offer? What are your capabilities? What's your experience? What skill set will you bring to this business and to this industry that may be complementary to something already happening, or it could be something completely new and innovative that you want to be able to roll out to the market? Who are your potential customers? And it's important that you really understand who your target audience is. And then the overall business environment. So a situational analysis can be used for both a startup or an existing business. You can talk about it from the perspective of this is where we've been in the first year of business. This is what we've achieved. This is what the market looks like now as compared to when we started. These are the skills that we're bringing. Again, who are the customers? And what does it look like out there right now? I think any situational analysis needs to talk about COVID, and we're going to talk about COVID again a little bit further down, but it's not gone, and it is impacting things like supply chains and employee availability of staff, that kind of thing. So you need to be aware of that as well. I had on the slide before an executive summary. That can be for a startup business, and it really just summarizes the rest of the plan. So it's at the beginning of the document, but it's the last thing you write, and it really just captures a few sentences from each section of the document. So corporate structures and registering your business. This is my little play on words. There are 3 main corporate structures. There's a sole proprietorship, there's a partnership, and there's a corporation. There's also a cooperative, but I see those very seldom, so I'm not going to talk about them today. A sole proprietorship, in its purest form, is you and the business are the same legal entity. There's no separation of the business from your personal tax situation. So whatever revenue, whatever income or loss that the business would take at the end of the year would be your personal income or loss. And you would include it in your personal income tax return on a form called a T2125. Now, there are benefits to this. You pay less income tax as a sole proprietorship than a corporation, but there's also higher risk because, again, as a sole proprietor, you and the business are the same legal entity. So if someone were to sue you, they would be, or your business, they'd be suing you in essence. So pros and cons. A partnership is basically that, 2 people, or it could be more, but generally it's 2 people who are starting a business together. And then you would need to determine things like who's the decision maker, if you have a disagreement, and what happens if one person wants to leave the partnership, that kind of thing. It's set up essentially the same as a sole proprietorship. A sole proprietorship is considered a partnership of 1, and a partnership is considered a partnership of 2. So you have the same kind of legal situation. You would split the income 50-50 potentially, but you're still considered the same legal entity as the business. Now, a corporation is different in that it is a separate legal entity. So you would be a director under the corporation, but you would have a separate tax filing. You do your own personal income taxes, you do your corporate income taxes. And in the event someone were to sue your corporation, they would first come after the assets of the corporation. And that's not to say it wouldn't trickle down to you eventually, but in general terms, They'll come after the assets of the corporation, and that will be looked after, and it wouldn't affect you in the same way. So sole proprietorship and partnership, when you register through joint stocks, which is going to be my next topic, costs about $121. Corporation is more expensive. It's generally in the $1,500 range when you're starting your business up and you incorporate at the beginning of the business. You may begin operating as a sole proprietor or a partnership and run until such time as you make enough money that it makes sense for you to incorporate. Because once you get to about $80,000 in revenue in a year, you're paying too much income tax. So you'll want to, at that point, talk to your lawyer and your tax accountant about, does it make sense to incorporate at this point? So again, if you incorporate down the road, it will be more like $4,000 to $5,000 because of the amount of work that has to happen to close off the one set of books and start the next set of books. So I always recommend to people that they talk with both an accountant and a lawyer before they make a decision on the structure that their business should be in, because it does have ramifications depending on, how you set it up for taxation and legal as well. So people often ask me, do I have to register my business with joint stocks? Well, the short answer to that really is, if you're going to use anything but your first and last name, yes, you have to. So if you're going to operate as John Doe and just John Doe, and that's your name, then you're fine not to register. But in saying that, there's also no protection if somebody else wants to start operating as John Doe too. So it's a little bit of protection if you register with joint stocks from that perspective. But if you're going to be John Doe Tree Farm, then you absolutely must register with joint stocks. So when you register with the Registry of Joint Stocks, you now get a 9-digit Canada Revenue Business Number allotted to you, allocated to you, when you register your 7-digit number with joint stocks. That doesn't activate your HST. So if you're going to be charging HST, then you need to contact Canada Revenue and ask them to activate your business number and add the HST onto it. There's also a separate extension for payroll if you're going to be having employees. So the harmonized sales tax $30,000 rule, if you're not charging HST from the moment you start your business, but you hit $30,000 within 4 consecutive quarters, then you must begin charging HST. So you might start your business July 1st and think that you don't have to worry about it because July to December you won't, but it's 4 consecutive quarters. So it could be July 1st of this year to June 30th of next year. If you hit $30,000 in gross revenue during that time, then you must begin charging HST. So if you're pretty sure that's going to happen, I generally suggest that you start charging HST from the start so that you don't have to worry about making sure that you caught it when the time does come, because the moment you hit that 30,000 threshold, CRA will be expecting you to be remitting HST for it, and you don't want to mess that up. Okay, so moving along, vision. Really, what do you want to be when you grow up? It's your long-term goal for your business. Now, 10 years these days might be a little bit ambitious. I mean, COVID has changed the length of business plans from, a long-term plan 5 years to a long-term plan being a year or 2 years, because the market has changed so greatly. Industries have changed, supply chains are challenging, that kind of thing. But a vision is really focused on how you impact the world, not how much money you're making. So how people feel when they've had an experience with your business, or you could call it your why. What is your rationale? What are your lofty goals for where you see the business in 5 to 10 years? So the vision is the why. The mission statement is the how, or the what. How are you going to get there? So it's an action-based statement that declares the purpose of the organization and how they serve their customers. It's kind of a short summary of the company's purpose, and it does, again, provide clarity around the what and the how. So the vision is the why, and the mission is the what and the how. Not every business plan has a vision and a mission statement. Some people find it really helps them, again, to focus, to really drill down to what is their reason, why are they doing what they're doing. Some people don't tend to get into this at the very beginning. But even if you have a core set of values, what are the important values for your business? How will you operate when you're dealing with your public, your customers, and your suppliers? That alone will help give you, again, some clarity on what your position is and why you're doing what you're doing. Some examples of vision and mission statements. Tesla, the vision statement is to accelerate the world's transition to sustainable energy. They have great car double entendres in here. Their mission statement: to create the most compelling car company of the 21st century by driving the world's transition to electric vehicles. So the vision is what they want to be, and the mission is how they're going to get there. And again, IKEA, their vision statement is to create a better everyday life for the many people. It really is. And mission is to offer a wide range of well-designed functional home furnishing products at prices so low that as many people as possible will be able to afford them. So again, the vision is the why, and the mission is the how. Okay. So again, getting back to what's included, the product or service description. These are some of our clients here at Noble. We've got Wa River Stables up on the right-hand side there between, Earltown and Tatamagouche. We've got Hard Honey, who are actually in Tatamagouche as well, who make mead. And then the Poo Wizard, who's based out of Truro, and he looks after your pets, whether you're at work, at play, or away. I think this is tagline. And they've all come through our office at one time or another. So your product or service description, what is it that you deliver? Do you make something? What do you make? Go into detail about how you make it. Do you sell a service of some kind? What is that? And how do you evaluate it? What are your costs for creating that product or service? And then what are you selling it for? Do you have a cost of goods that you need to talk about? What does that look like? What benefit does your product or service provide, or what problem does it solve? And really, if you're not solving somebody's problem, you may have challenges maintaining a market share, because it really is about what does your product do for someone. We'll talk a bit more about that in researching it. So your value proposition is a promise of value to be delivered, communicated, and acknowledged. It's also a belief from the customer about how value will be delivered, experienced, and acquired. So here's what are your customer needs and what do they care about? And this is what you do really well. So the overlap there is your unique value proposition or your unique selling proposition. So what your competition does really well needs to be in there too, because hopefully their weaknesses are your strengths. And we're going to talk about that as well. Okay, so your customers, who are they? How many of them are there? Where are they? What do they need? What are their pain points again? How do they make their buying decisions? Where do they buy? How do you reach them with your marketing and sales messages? So let's dig down a little bit into that. Many people will come into my office and I'll ask them of this business idea that they have. So who's your target audience? And the response is almost always everybody. Well, I would challenge that. And I do challenge that, because not every product will be attractive to every person. You just need to figure that out. So who are they is really understanding who is your target audience. And depending on the product that you're selling, you could have 3 or 4 what's referred to as ideal customer avatars. So who is kind of the prime example of the person who's going to want your product or service? So if it's a shoe store that you're going to open, you probably have younger people looking for track shoes and sport shoes, sneakers, that kind of thing. You might have families looking for footwear for their children or for themselves. And you might have older folks who have bunions and corns and need really comfortable shoes to be able to walk comfortably. And that's kind of oversimplifying it, but it really is. A shoe store wouldn't necessarily appeal to everybody depending on what shoes they carry. So, if you're a 90-year-old woman, you're probably not going into a store that only carries high heel shoes and men's shoes if you're a older lady. So you need to think about who are your customers and what are their specific demographics. What's their income level look like? Do both, if it's a married couple, do they both work outside the home? Do they have children? Do they have dogs? How many vehicles do they have? Do they live in a town, or are they more rural? That kind of thing. How many of them are there would be, of the population, say, of Colchester County, which is, about 50,000, how many of your demographic live in Colchester County or in your county? So that's, where are they as well? Do they live in town? Do they live in the country? Are they within a certain radius of you? What do they need? What are their pain points? What problem are you solving for them with your product? How do they make their buying decisions? Do they research online first? Or do they go into stores and check out products there? Do they ask their friends and family for recommendations? How do they make their buying decisions? Where do they buy? Again, are they buying at big box stores? Are they buying locally at smaller mom and pop operations? Are they ordering online? And we saw such a huge influx of online ordering during the first year of COVID. Has that changed? Are they still spending most of their disposable dollars online? Or have they switched to more local? And then how do you reach them with your marketing and sales messages as well? What platforms will you use? Because different people are on different platforms. You're probably not going to catch a 18-year-old reading the newspaper in hard copy. You might catch them reading it online. Are you going to, but yet most seniors will read the newspaper. So if you're trying to attract an older demographic, then advertising in the newspaper may make sense for you. And as well with social media, there are different platforms and different demographics are on the different platforms. So someone who's on Instagram may not be on Facebook, may not be on TikTok as well. So you need to really understand where your target audience is and then target your marketing to them. All right. So how do you find out the research for your customers and about the market in general? So you need to research everything before you get into it, obviously. You're going to want to figure out who your target audience is. You're going to want to figure out who the competitors are. You're going to want to look at what the market situation is right now. What are the trends? All of that can be found pretty much online these days, but also at libraries and in different places. So your competitors' locations. If you are setting up a storefront or a restaurant or someplace that people will frequent, you can go to your competitors and see what they're doing. You can go to the competitors' websites as well. You certainly should. But who's doing what? Who in the market is already doing what? Social media, of course, it's a necessary evil these days. You have to be on social media and you have to check out who's doing what on social media. So if somebody got a really great presence for their business on Facebook, but they're not on Instagram, well, maybe that's where you make your mark. Industry associations will be able to give you lots of stats and helpful information on what the trends are and what's coming down the pipe and what the challenges have been. Their website, their newsletters, they've probably got historical data that they can share with you as well. The Chamber of Commerce or Board of Trade in your area will be able to provide you that kind of information on businesses and how many businesses have started up and the number of individuals. I forgot to put municipal government websites on there because you'll also find information there about how many businesses, how many residents, how many work in the area, that kind of thing. In this case, the Farm Loan Board or Farm Credit Canada might be a good resource for you. They may be able to provide you with some stats and some information on who's what and where are they, basically. The census, and I believe the last census was in 2016. Well, we did one last year, but they haven't released the data on it yet. But census information gives you a great deal of data about how many of the residents, what's the population of your target area? What kind of, they have demographic information there too. How many 2-person households, how many 2-car households, do they have a dog? That kind of thing. I think they ask about dogs, but not cats. But anyway, Your census will give you a great deal of information as well. Statistics Canada is a great resource. Again, that's kind of what they do, is all sorts of stats. So you can go on their site and search for specific information about your industry. There are also different websites, which I've listed here: statista.ca, ibisworld.com, the NPD group, not NDP, but npdgroup.com. Mordor Intelligence has a whole section on industry reports. Allied Market Research, I do believe you have to pay for that. But again, if you're depending on how deep a dive you're going to do into your business plan and your research, it may make sense for you to pay to get some additional detail, so that you know you're targeting the right audience and that you're getting the information that you need to make the right business decisions. Okay, so in keeping with all the research, who are your competitors? Where are your competitors? Are they the mom and pop shop down the street, or are they online ordering? Are they a big box store? Is it, Amazon, or is it somebody else smaller? How big are they? What products or services do they sell? Again, something like Amazon that started out as a bookstore but now sells everything. Do you really want to compete with them? Does it make sense for you to try to compete with them? Probably not. What is their pricing model? How do they price? Are they like Walmart, where they have such a large volume purchase that they can undercut other places? Does that make sense for you to try to compete with them? Cheaper isn't always better. So how are they pricing their products? What is their value proposition? So what are their customers' needs and what do they do really well? Is that addressing the pain points of all the people in your target demographic? How big is their share of the market? Which is important. If you to track this kind of information, and market share can be difficult to find, but to understand how you're doing in comparison to your competitors, it is helpful to have an understanding of how much of the market do they own. Do they have 95% of the market and you're going to try to eke out some percentage from the rest of the 5% that everybody else is? Or are things pretty evenly balanced and maybe they've got 40% of the market and there's another half a dozen businesses that are sharing the other 60%? Where do you fit in? Pardon me. What do they do well? And then what do they not do well? Which is really important. Understanding where their strengths are and where their weaknesses are. And hopefully their weaknesses are your strengths. That leads me into a SWOT analysis. SWOT stands for strengths, weaknesses, opportunities, and threats. So strengths and weaknesses are basically internally focused. So they are things that you have control over. If you're not good at something, then you can learn how to get better at that, or you can add on another product line, or you can bring somebody on board who can help you with that. Opportunities and threats are external. So you have absolutely no control over them, but it might be a good opportunity for you, or it might be something you just have to learn how to manage. So strengths include things like, what does your company do well? What are the qualities that separate you from your competitors? They are internal resources such as, your staff. Could be your location. Tangible assets such as intellectual property, capital, proprietary technologies, that kind of thing. Weaknesses, what are areas that your company lacks? And that might be in personnel, that might be financial limitations, it might be you opened up shop in a really bad location. So how do you address that? Opportunities, underserved markets, a few competitors, emerging need for your product or services. I would think, 2 years ago when everything shut down and we all needed PPE, and there were businesses that adapted from creating one product and went into creating another product. So distilleries who were making gin or vodka all of a sudden pivoted and started making hand sanitizer. In different places like Stanfield's, who had been, of course, making undergarments and started making gowns and PPE. So that was a good opportunity for them. Threats could be emerging competitors. So you run a restaurant on a really busy street and a restaurant with the same kind of menu opens across the street from you. That's a threat. You have no control over it, but you need to figure out how to work within that and hopefully rise above it. Changing regulatory environment, negative press or media coverage. Again, people writing reviews online that you really can't control, but you need to manage. Changing customer attitudes towards your company as well. And of course, COVID would fall under threat. And again, for some, it was an opportunity. But it was a threat for many businesses because there was no idea when the end would be in sight. And we're still not out of it 2 years later. But how did that impact your business? So to do a really efficient SWOT analysis, you should actually compare yourself to your competitors. So you could do a SWOT across the top this way. You could write your business along the top, and then you could write your 2 or 3 competitors down the list and say, what are your strengths, weaknesses, opportunities, and threats? What's competitor 1's strengths, weaknesses, opportunities, and threats, competitor 2, competitor 3. That will really give you a good idea of where you all fit in the market. So again, you hope that their weaknesses are your strengths. And that could be vice versa as well. But it's important that you understand what your competitors are doing, where they are, and what the opportunities might be. And an opportunity for you could be an opportunity for your competitor as well. Same with the threat. So are you on a level playing field? What do you need to look at to make sure that your strengths are the other competitors' weaknesses? I hope this all makes sense. Okay, so as part of that, you want to talk about your industry, the industry that you're going into. What has been the status quo for the past number of years? Where is it going? What are the trends? What's happening now? So you want to focus on the future. Always try to be a step ahead of your competitors. What are the developments and innovations that may impact your business? COVID has to be part of the conversation these days, because again, it changed how we do business 2 years ago. And now we need to look at, even though it's not as dire as it was in the last 2 years, it's still with us. There are still staff shortages because people are out sick with COVID. There are still things like restaurants are probably not as busy as they'd like to be because some people are still hesitant about coming out and dining in public at this point. And then there are things like, supply chain issues. Can you get the product, the raw ingredient that you need to create whatever it is you're doing? How is COVID going to continue to impact that? Are there enough trucks? What does the price of gas look like? And how does the price of gas impact your business? If the war in Ukraine continues, what will that look like? How will that impact your industry, your business? Okay, so market analysis. Again, this is all part of your plan, talking about your industry, talking about your market, talking about your competitors and who your customers are. So your market analysis is really this section over here. What does the market look like? Internal and external perspective. Again, you're going to want to do a lot of research to understand what's going on currently in the marketplace and where will you fit in. So the customer needs, define the market. What are the pain points? What problem are you solving for someone with your business? The company capabilities. What do you actually have the ability to do? Do you have enough staff to meet the needs of the customer? Do you have the financial means to meet those needs? Do you need to scale up very quickly from a solopreneur, one individual working, to maybe a number of staff because of the demand in the market? What is the competition and the market dynamics? Again, we've talked a lot about that, but who are the collaborators who can help you get there as well? Market selection, so market segmentation and selection. Where do you fit? Who do you want to go after? And how are you going to do that? So if business A has 50% of the market, are you going to go after their business? And you may or may not, depending on your individual situation and what is sensible for you. But you need to understand who's out there, who has what market share, and how are you going to try to fit into that. and then you're going to position your product accordingly. With the marketing mix, these are the 4 Ps: product, price, place, and promotion. What do we sell? Where are we selling it? How do we sell it? And how do we retain customers is the next part of that. So what is your product? Make sure you understand exactly what it is you're offering. Make sure that that's clear. What is your price? How does that fit? I'll generally tell people you don't want to be the most expensive nor the least expensive in the marketplace. You want to fit somewhere just north of mid-range. Unless you've got the best darn thing that's ever been, and then maybe you do want to be the most expensive. Every product is slightly different. Place is, how are you distributing it? How are you getting it to your clients? Is it sold locally? Are you shipping it somewhere? How's that impacted now, again, by the price of gas? And then advertising and promotion is, where are you marketing it? Are you on social media? Do you have a website? Are you in magazines, newspapers? Are you on the radio? Are you setting up signage at your location so people can stop and buy from you right there? What does that all look like? And then customer acquisition is, how do you get customers? How do you keep their interest? How do you get the sale from them? And then how do you keep them? What's your retention plan? Because it's a heck of a lot cheaper to keep existing customers than it is to go out and try to find new ones. All right, so the marketing mix, again, this is the 4 Ps: product, price, promotion, and place. So product is the quality, the design, the branding, the features, packaging, the functionality, the availability. Price, what's your pricing strategy? What's your list price? What's your cost of goods sold? Do you offer credit? Do you have what payment methods do you have? Is there a payment period? Do you charge interest if it is late? If you're extending credit. Promotion, things like advertising. What's your sales promotions? Are you giving away product to try to entice people? Do you have public relations happening? Is there press releases and that kind of stuff? Have you got social media happening? Have you got sponsorships? Are you inviting influencers to try your product and then comment on it? And then place, what channels are you using? So newspaper, radio, social media, website, signage out front. Transportation, what's your location? What are the logistics? What's your inventory look like? Are you going to have e-commerce? There's a lot to it. All right, so we're coming up on financials. Financial statements provide, again, a roadmap and a snapshot of the corporation's financial health. And they're essential because they provide information about the financial goals of the company and then whether you're going to be able to service your debt as you move forward. Banks and other investors, such as CBDCs, use the financial statements to determine the level of risk they're taking by investing in the business. And again, there's 3 major statements. There's a cash flow model, an income statement, and a balance sheet that every lender is going to want to see, and you should have done to address, to set your goals again. So a cash flow model is different from a budget. My background is in hotel management, and we used to create a budget every year that talked about when we would record, or we would list when we would record the revenue. So you might have a big conference in that was $100,000 in revenue, but they were here in July, they check out, they leave, you invoice them, and you might get paid 60 days later. So we record the revenue in July because that's when they stayed, they incurred the charges. But if you're doing a cash flow model, you would show the revenue to come in September, because that's when you're going to get paid. So what we would do in the hotel was write a budget every year for what every month of the next year looked like. But then every Monday, you'd do a cash flow to determine when the cash was actually going to be in the bank account. That way you'd know, can I make payroll? Can I pay the debt, whatever debt I need to service, that kind of thing. So it summarizes, a cash flow summarizes the amount of cash and cash equivalents coming in and out of the bank account basically each month. So the cash flow statement measures how well a company manages its cash position and whether they can generate enough cash to pay their debt. So here you can see in the example, in January, there was $323 in cash sales, no payments received on account, no other investment. So they had a subtotal of $323. their cash out was pretty higher. So they had $10,711 in total spendings, which left them in quite a deficit there. So they really needed to have an influx of cash to bring it back to a positive point. And we have templates for all these kind of things at the CBDC offices, so you can certainly get some help filling out your cash flow statement. It's generally 12 months. Sometimes we'll ask for 24, depending on what it is that you're doing. But you would think about when you're going to get the money versus when you're going to record the revenue. Especially if you're working with businesses like Irving or Sobeys or the government, federal government especially, they tend to be on 90-day payment terms. So you might invoice them in January for $10,000, but it's probably going to be sometime in April when you actually get paid for that. So it's great to record the revenue in January, but if you need to understand if you can make payroll for the next couple of months, you need to know that that money isn't going to be in your bank until April. So what do you need to do in the meantime to make sure that you have enough cash to service your debt, pay your staff, keep the lights on, basically? An income statement, or a profit and loss, it's often referred to as well, shows the revenue and expenses and cost of goods sold over a set period of time, generally 1 month or 1 year, although you can run them quarterly or you can run them for a certain period of time, depending on your software that you're using. So the revenues, and this is a very simplified one, the revenues for this business for the year ending December 31st, 2019 was $2 million. They had expenses, their cost of goods sold, so what it cost them to actually make the product that they were selling, was $700,000. They had advertising, depreciation, rent, payroll taxes, salaries and wages, supplies, travel, entertainment. So their total expenses were $1.9 million, which left them with a net income of $100,000. So if you are working with a bookkeeper, you should get your statements back, especially your income statement, back monthly, ideally, so that you can look at where you are and see if you are making money. If you have cash in the bank, a lot of people think that means they're making money. It doesn't. It's a completely separate thing. Having cash flow is one issue. Having a net income, making money, is completely different. So you need to understand what both documents are to understand if you are actually a going concern, as they say. This business is making money. And they may have very little cash in the bank because of their cash flow model and when they've got things coming in. But in this situation, this business is profitable. So the next document would be a balance sheet. And again, the balance refers to assets. The equation is assets equals liabilities plus equity. So assets, your top half, needs to balance with your bottom half, which is liabilities and equity. So assets are things which you own. Liabilities are what you owe on that. So what is your debt? So in this situation, a balance sheet is generally done again once a year, but you might get one every month from your accountant. It may not change that greatly month to month, but there will be things like depreciation that will happen over the year. So in this situation, you have cash of $57,000 this year, and you have accounts receivable of $209,811. Your inventory value is at $47,000, which is actually kind of high depending on what the business is. Your fixed assets would be things like furniture, fixtures, equipment, buildings, land, that kind of thing. Intangible assets, which is the entry here, generally is a number often referred to as goodwill, which would be a number that they use to balance the statement, balance the sheet. So down here, you've got accounts payable of $89,103, a demand loan of $52,708, HST payable of $6,000, and the current portion of long-term debt is $25,000. So one thing that we look at is if you have enough cash in the bank to service the debt. Well, if you have $57,000 in cash and $89,103 in accounts payable, that tells me you don't have enough liquidity to actually service your debt. But if you get on it and start collecting some of that accounts receivable, then you probably would be okay. But somebody needs to get on top of that $209,000 in accounts receivable, because you need to be bringing that in. That needs to be coming in as cash. So your assets and your liabilities, or assets equals liabilities plus equity. So down here is your stock retained earnings. So your retained earnings from 1 year closing becomes your retained earnings the next year opening, that kind of thing. So this is important because it really does show the health of the business. So yeah, again, what you own versus what you owe, and do you have enough liquidity that you can service your debts, you can pay your debts. Okay, something else that I don't know that I had on the overview, but an exit strategy is something that you should be thinking about. And when people come in to meet with me, I often have conversations where I'll ask, what's your exit strategy? You're starting this business, what's your end game? And they haven't thought about it. And I would suggest that this is something you want to think about up front, because it may change how you run your business. So what is your long-term plan? Are you thinking you'll sell the business for a profit in 5, 10, 20 years? Are you going to leave it to family? Do they know that? And that sounds like I'm joking, but I, again, have had people who come in and say, my son's in university and he's going to come home and run the business. And I'll ask, have you had an explicit conversation about that? And asked him, and well, no, they just assumed. And sometimes the son or daughter decides that they don't want to do that. So leaving it to the family isn't always going to work. And you're going to run it and then close it when you retire. And any and all of those are fine, as long as you've given some thought to it. Because again, it may change the way you structure your business. If you're going to sell the business for a profit in 5 or 10 years, instead of having your accountant do notice to reader reports at the end of the year, you might have them do a full audit or a review engagement at very least, because you're going to want to be able to prove that your books are in good order and that the business has the value that you've assigned to it when you try to sell it. So something to think about. Okay, there are a number of online templates where you can find business plans. We have one at cbdc.ca. It is a fillable PDF. I would say that it's not necessarily my favorite, because I find it does, like the size of the boxes might limit your thinking process. But for some people, it's a good place to start, because they can pull that off and start filling in the blanks. And then when they want to actually write their full-fledged business plan, they'll have something to go on. They'll have some notes already written. Scotiabank has a good one. BDC has a good one. The one at the bottom as well, Law Depot. You can actually pick which industry you're going into, and then it will tailor that template a little bit for that industry, which might be quite helpful. There are also some other associated documents which I'm including with the presentation, which you'll be able to find on the website, and that can help you as well. Here are some other resources: cbdc.ca, noblebusinessskills.ca is our specific CBDC's website. There's the Truro Colchester Partnership for Economic Prosperity, Nova Scotia Business Inc., Atlantic Canada Opportunities Agency, canadabusiness.ca, bdc.ca, The Balance, entrepreneur.com, and futurepreneur.com. Those are all great. The top two obviously are only for Colchester County, but everything else is fairly generic and would be able to give you some helpful guidance on starting a business. And then, as I mentioned earlier, I am located in the Colchester County office, and our organization, CBDC NOBL, is responsible for Colchester, Pictou, and Antigonish counties. If you're in a region that does not fall within one of those 3 counties, I suggest you go to cbdc.ca, and on the right-hand side of the screen, there's an option to find my CBDC. You can then choose your region, and it will tell you which office is closest to you and which one you can contact for more assistance. So for that, I will say thank you, and I hope that this information has been helpful. If you are in Colchester County and I can be of assistance, don't hesitate to reach out to me. My number is 902-895-6625, and my email is alana.hirtle@cbdc.ca. Thanks very much.